Okay, today we are going to talk about chapter 8, which is receivables, about receivables, account receivable, and notes receivable. Uh, so, receivables are assets, account receivable are considered current asset, note receivable, depending, could be a long term asset if its life is greater than 1 year, and it's a current asset which has a life of less than 1 year. So in this question, in receivables, so when we sell our merchandise on accounts, we have receivables. So when we have receivables, there is always a chance that a customer might not pay what they owe to us. So in that case, a business needs to allocate or needs to assign a certain amount, and it's called allowance method. In this method, we keep a certain allowance, not actual money set aside, but since it's a what we call it a two-way accounting or accrual based accounting, so we have to accrue in advance what could potentially we lose if we sell to our customers on account or credit. So for example, there is one method is called percentage of sales method or percent of sales method. In this method, a business estimate that what percentage of sales will not be materialized as a collection, means we will never recover our money from our customer. So in that scenario, some businesses say it's a 1%, some say 1.5%, 2%, 3%, 2.5%. So depending. So this information will be provided to you in a question, whether it's an exam question, quiz question, or homework question, what percentage we are assigning for allowance. And there is another method that is called aging of account receivable, which is not part of this question. However, we also use aging of account receivable. So percentage of sales method we use throughout the year, and at the end of the year we also use aging of receivables. So in aging of receivable, we assign uh, probabilities to the account receivable, that what are the chances. So if an account receivable is only 30 days old, so there is probably 99% chance that we will recover the money. However, if the receivable is 6 months old and that we haven't collected the money from our customer in the last 6 months, means it is there is a 50-50 chance at best that we may or may not be able to collect money from the customer. So in this scenario, we are going to work on this question, which is 829A. And in this one, accounting for uncollectible account using the allowance method, which we use percentage of sales, and a direct write-off method, and reporting receivable on balance sheet, how we report our receivable on the balance sheet. So August 31st, this company, Floral Supply, had $140,000 worth of account receivable and $5,600 in allowance for bad debt. So during September, Bank Bouquet made these following information they provide. Sale on account during September was $550,000, and collection on account was $584,000. Means this company sold to their customers on credit merchandise worth $550,000, and they also have collected from all their customers $584, and write-offs were $4,000, means they did write off the amount they couldn't collect from the customers. All right, so let's see what are the requirements. The requirements we have: the journalize all September entries using allowance method. Bad debt expense was determined at 2% of credit sales. Show all September activity in accounts receivable, allowance for bad debts, and bad debt expense. So we have to use the T account to do this. So what we are going to do here, we grab a different piece of paper and we're going to write down our requirement number 1. So first requirement is we have to make journal entries. So when we're going to make a journal entry, the journal entry is we have sale on account for $550,000. So that means on September 30th, we're going to debit account receivable because we are selling on credit $550,000, and we're going to credit sales revenue. So you remember from chapter 1 that once you give customers or provide customer the product or service, then the customer owes you, so you can recognize your sale as soon as you fulfill your part of the bargain. On that September 30th, we also going to say we have received during the month cash of $584,000. That means our account receivable is going down by $584,000. Also, we're going to make an entry that debit allowance for bad debts, and I'm going to show you in a minute using the T accounts, bad debts for $4,000, and we're going to credit account receivable for $4,000. And in this question, they told us that, in the requirement, they told us the bad debt expense is 2% of the credit sales. So first we have to calculate what is bad debt expense. So bad debt expense is equal to 2% of credit sales. So how much credit sales we have in the month of September is $550,000. So 2% of $550,000 is going to be how much? So I'm grab the calculator, $550,000 multiply by 0.02, and we get $11,000. So we have $11,000 of bad debt expense. So what we're going to do, we're going to say on September 30th, debit bad debt expense of $11,000, and we're going to credit allowance for bad debt of $11,000. So what this $11,000 means, what we are saying that the $550,000 sales we have just done on account, we might not be able to receive $11,000 from our, or we may not be able to collect from our customers these $11,000. This is not as a fact, it's just our estimate. That could be higher than 11,000, could be exactly 11,000, and it could be less than $11,000. So now once we enter this information in our system, how does it look like? So I'm going to show you various T accounts. So the first T account I'm going to show you is account receivable. As we know, the balance on the account receivable according to this was $140,000. So we starting with $140,000, and when we sale on credit $550,000, we got another $550,000 worth of account receivable. So basically we have a account for sales, debit and credit, and we have $550,000. And now we have another account, cash, where we collected cash. So our cash account has collected $584,000. So that $584,000 here, and it's so once when we sell anything on credit, that increases the balance on account receivable. But when we receive the cash, so I'm just going to say cash collected. This is my beginning balance, and this is credit sales of $550,000. And what else we did? We did allowance for doubtful accounts, and because we write off, so this is our write off of accounts receivable. So when we write off this way. So this is our allowance account, allowance for bad debts, debit and credit. It has a beginning balance according to this question. So they have a beginning balance of 5,600 credit balance. So we just put the 5,600 over here. But they are also saying that you have to increase this by $11,000 because you make a sale of $550,000 and you might not be able to recover these $11,000. So we have increased this 11,000, right? So this 11,000 is coming here because of this credit sales we have made. Also, we have write off. So when we write off, we always debit this allowance account. So we write off, so it's cash collected, write off of account receivable of $4,000. So that means we're reducing our account receivable. So what would be the balance of account receivable? So let's calculate here. We have $140,000 worth of account receivable when the month starts, plus we make a sale of $550,000. So we have a total of $690,000, and then we collected $584,000. So it reduces to $106,000, and we also subtract $4,000 because we write off. So we have a ending balance here as of this November 30th is $102,000. We also have a balance over here in allowance for bad debt is 5,600 plus 11,000 minus the 4,000 is equal to $12,600. Okay. So every time we make a sale, we have to estimate. So at the end of the month, the estimation was like 2% of the sales might not be available. So this allowance account is sort of a contra account to account receivable, and I'm going to share you more information in a bit. So this was our first what we call it, I forgot to make the bad debt expense, so I will make a bad debt expense of 11,000. All right. So the next thing is we go for the next requirement. What is the next requirement? Using the facts, assume Bouquet used the direct write-off method to account for uncollectible receivable. Journalize all September entries using the direct write-off method and post two accounts, receivable, bad debt expense, and show their balance at September 30. So now we are going to do the same question all over again for using direct write-off method. So we're going to do this second requirement. Requirement number 2 for a write-off method. In that method, the write-off method we do, since write-off method does not use the allowance method, so we are going to do again. So for example, it provides us information on August 31st, 2024, Flora Supply has $140,000 of account balance, and they have account receivable and then $5,600 in credit balance, but we do not know if there is a credit balance because we're not using the allowance. So sale on account is $550,000. So we're going to say debit account receivable for $550,000, and we're going to credit sales revenue for $550,000, and then we have a collection. So we're going to say debit cash for $550,000, and we're going to credit account receivable for $550,000, and we have a bad debt expense for $4,000 because we have write-off account receivable worth $4,000. So, and now we have to do the everything in the account receivable. So when we go to the account receivable, we have account receivable T account here. It is starting balance again is $140,000. So beginning balance $140,000. Credit sales is $550,000. Cash collected is 500 and cash collected was 584. I'm sorry, it's 584,000, and we write off for $4,000. So how much we have? We still have a balance of ending balance as of September 30th of $102,000. All these transactions were done on September 30th. Okay, now since we did this, so our bad debt expense account would be $4,000. Okay. Now this is second requirement. Now you notice that in the first requirement we have used an allowance method, and in the second we didn't use the allowance method, we use a direct write-off method. So that's a difference. In a direct write-off method you do not have any of these things, but direct write-off method is not allowed for companies who use GAAP, so it's not a true GAAP method. However, we do use a direct write-off method when we use books for taxation. So for IRS we use direct write-off method, but for GAAP we use only the allowance method. So this method will be used most of the time, and this method, the direct write-off method, used by very small business, mom and pop stores, and for taxation. Okay, let's see what is a requirement number 3 for this question. So the requirement 3 for this question is what amount of bad debt expense would Bouquet report on its September income statement under each of the two methods? Which amount better matches the expense with revenue? Give your reasons. All right, so we go to requirement number 3 here. So requirement number 3. In the requirement number 3, which method we are going to use? So on an income statement, bad debt expense where we use two different methods. So if we use a direct write-off allowance method, under allowance method it will be $11,000 that we have calculated, and under direct write-off method we're going to use $4,000. Now which one is the best? Well, the $4,000 what you have written off, $11,000 is based on your sales. Since you are using an allowance method, it is a better representation of your revenue and expense. As you remember from chapter number 1, we have to recognize all the revenues that we have incurred, which we have earned during the period. Period simply means a month, a quarter, or a year. So we have earned a sales of $550,000 in the month of September, and we believe that $11,000 at 2% of our sales we might not be able to recover. So this $4,000 does not belong to the sale of this month. They belong maybe 3 or maybe 6 months or maybe a year-old sale. So this $11,000 is a better representation on the income statement for all your revenues and expense because it relates to the sale of this month. So let's talk about requirement number 4. Under this requirement, what we have to offer, what amount of net accounts receivable, net account receivable, would book a report on its September 30th, 2024 balance sheet under each of the two methods. Which amount is most realistic? Give your reason. So when we are talking about balance sheet, on a balance sheet, this is what we list our account. Account receivable minus allowance for uncollectible is equal to net account receivable. Sometimes you will see a word gross here, and sometimes you just see account receivable. So if we look at the our solution for the allowance method, you notice that the allowance method we have done, we start with 5,600 from the previous month. $11,000 represent this month of September sales. This 4,000 represent what we have. So what we left is 12,600. So we're going to use the ending balance of both this account receivable and this allowance to show off what actually we have. So account receivable we have 102,000, and the allowance we have is 12,600. So the net account receivable turns out to be 89,400. So what this 89,400 means? It simply means, based on our calculation, right now our customer owes us 102,000, and we believe the 12,600 allowance that we have so far for them, based on throughout the year, well, say from January 1st to November, September 30th, we believe we may not be able to collect 12,600. Maybe means we can collect, we may have to write off more than 12,600 or less than 12. So we believe the true value of our account receivable is $89,400. Okay, and so this is our allowance method. So what would be under direct write-off method? So I'm going to show you direct write-off method on the other side. So direct write-off method. If you are using direct write-off method under balance sheet, your account receivable would be just listed as $102,000 because you are not using any allowance, so you do not have allowance. So that's how under balance sheet you will be listing your account receivable is 102,000, means you write off whenever it comes. Okay, so again in this question, account receivable is a balance sheet account, allowance for doubtful account is a balance sheet account, but the bad debt expense is a income statement account. Sales is an income statement account. Cash is a balance sheet account. So you need to remember this as well. If you have any question, please feel free to send me an email about this video, or if you want to ask any more questions and you don't want to send an email, you can show up on my Zoom office hours. I would be happy to answer any question you may have. Again, thank you for watching this video, and we'll see you in the next video.